Welcome back to the deep dive. Today, we're cracking open a book that's less investment manual, well, more like a manifesto, really, a challenge to the whole financial system.
We are talking about John C. Bogle's foundational work, The Little Book of Common Sense Investing.
Right. And our mission for you today, we want to cut straight through all the noise, the complexity you usually hear about investing.
Yeah, and just synthesize Bogle's philosophy. It's incredibly simple, he argues, almost irrefutable, and it's the only way, in his view, to guarantee you get your fair share of whatever the stock market delivers.
And it involves doing surprisingly little.
Exactly. Less is more, very much so.
Now, Bogle, just for context, he wasn't some armchair theorist. He founded Vanguard. He basically invented the modern index fund.
A true revolutionary figure. The book came out in '07, updated in 2017, and it's essentially him giving the average person the keys while telling Wall Street to maybe take a back seat.
There's definitely that edge to it, and his core idea, you hear it all the time, don't look for the needle in the haystack.
Just buy the haystack. That metaphor says it all, doesn't it? It sets up index funds perfectly, but it's also, like you said, a shot across the bow of active management.
Okay, let's unpack that shot. Bogle calls trying to beat the market, searching for that needle. He calls it a loser's game. Why? Why is trying hard, trying to pick winners, guaranteed to lose?
Okay, so think about it like this. Before you factor in any costs, investing is a zero-sum game relative to the market return. For every investor who beats the market average, someone else has to underperform it by the same amount.
Right, because all the stocks together are the market. So the average return for everyone must equal the market return before costs.
Exactly. Before cost, that's the key phrase. So if the average is just matching the market, where does the underperformance come from?
The middlemen, the fees.
Precisely. Bogle's fundamental law is just pure arithmetic. The more the managers and brokers take, the less investors make. It's simple subtraction. Every dollar paid in fees, commissions, or lost to unnecessary trading comes directly out of your return.
Which leads to his grim irony of investing.
Yeah, the idea that investors get precisely what we don't pay for. Pay nothing and extra fees for active management, essentially. And you get everything the market offers, pay a lot, and you get, well, less.
So if the math is just so starkly against active management, why do so many smart people, institutions even, keep playing that game? Is it just ego?
Well, partly maybe, but Bogle nails the two biggest culprits. Expenses and emotions. They work together, you see. The high expenses create this pressure to outperform, to justify the cost.
Ah, okay, so the cost itself fuels bad decisions.
Right, it makes you chase hot stocks, maybe panic sell when things dip because you feel like you have to make up for those fees. The expenses are the kindling and emotions are the match.
And that panic, that emotion, it makes us focus on the wrong things, like the daily news cycle, the hype.
Exactly. We focus on the noise.
Right.
Bogle insists you prioritize business reality, things like actual dividend yields, real earnings growth over just market expectations.
He had that great line, the stock market is a voting machine in the short run.
But a weighing machine in the long run. Spot on. The voting machine is popularity, hype, sentiment. Does the market like this stock today?
So Tesla being popular or a meme stock flying high, that's the voting machine.
That's the voting machine working overtime, yeah. But the weighing machine, that's about substance. What are the actual earnings? Can the company sustain and grow its dividends? What's the real underlying value? Bogle says ignore the votes, focus on the weight.
Okay, so if the math says active management is a losing game because of costs and emotions make it even worse, Bogle's solution had to be something that sidestepped both.
It had to be. And that's why he landed on something so, well, simple, his winning formula. The simplest and most efficient investment strategy is to buy and hold all of the nation's publicly held businesses at very low cost.
The classic index fund, buy the haystack.
Yep. Own the entire market through one fund. You guarantee you get the market's return, minus, crucially, almost negligible costs, because you are the market at that point.
And the action plan?
Almost laughably simple. Owning the entire stock market through an index fund and then doing nothing. Just stay the course. Don't tinker. Don't trade. Just hold.
It sounds like Occam's razor applied to finance. The simplest solution is the best. We humans love complexity, though, don't we? We think a perfect plan must be complicated.
We do, and Bogle warns us about that explicitly. He quotes, "The greatest enemy of a good plan is the dream of a perfect plan." Indexing is the good plan. It works. It's mathematically sound.
But it's not exciting. It doesn't give you bragging rights down the pub about picking the next big thing.
No, it doesn't. The discipline is the hard part. Sticking with it when the market's down or when your neighbor's bragging about some crypto coin, that's where the real challenge lies, not in the strategy itself.
Okay, let's really hammer home why that discipline matters, why costs are so critical. You mentioned some data.
Yeah, the arithmetic is just brutal when you look at it over time. There's this academic study looked at the bull market from 1990 to 1996. Strong market, right? The overall market return was fantastic, about 17.9% per year.
Wow, okay, great time to be invested.
You'd think. But they looked at the most active traders, the
Hmm.
ones constantly buying and selling, really trying to time things and pick winners. Before costs, yeah, they earned that 17.9% market return too, on average.
Okay,
But, okay, their trading cost commissions, spreads, all that friction averaged about 6.5% per year.
6.5% just evaporated into the system.
Gone, wiped out. So their actual take-home return was only 11.4%. They gave up a full third of the market's gains just through the act of trading. They might have had some wins, but the costs just killed their overall result.
Wow. Okay, so they earned 17.9, lost 6.5 to the system. That's why Bogle uses the casino analogy, isn't it? The house always wins.
It has to. He says, in the game of investing, the financial croupiers always win, and investors as a group lose. After the deduction of the cost of investing, beating the stock market is a loser's game. The math guarantees it. And imagine that 6.5% difference compounded over, say, 30 or 40 years. It's the difference between retiring wealthy and, well, not.
It's staggering. No wonder he was so confident, almost dismissive, saying something like, if the data do not prove that indexing wins, well, the data are wrong.
He knew the math was immutable. Costs are relentless. And that's why index funds work. They slash those costs. They don't need huge teams of analysts trying to guess the future.
They just need a computer to track the index.
Basically, yeah. It's automation, efficiency. Pass the savings to the investor. That's the whole Vanguard model he built.
Right. Okay, so for someone listening thinking, all right, I'm sold on indexing on low costs, how do they actually do it? What about things like, how much to put in stocks versus bonds?
Bogle offered some simple rules of thumb. Again, simplicity is key. These aren't rigid laws, but guidelines. The traditional one you hear is your age in bonds. So if you're 40, have 40% in bonds, 60% in stocks.
Okay, that's pretty conservative. What about younger people still saving aggressively?
Yeah, for people in the accumulation phase working, saving he'd suggest being much heavier on stocks to capture long-term growth. Maybe 80% stocks, 20% bonds if you're young, perhaps easing to 70-30 as you get a bit older. Time is on your side to ride out market bumps.
Makes sense. And then for retirees, people actually drawing money out.
That's the distribution phase. The focus shifts hard towards protecting your capital. You need that money to live on. So more conservative, maybe 60% stocks, 40% bonds for younger retirees, even 50-50 for older retirees. You need that bond cushion so you're not forced to sell stocks when the market crashes.
Got it. What about target date funds? TDFs. They're everywhere now. They automate that stock bond shift over time. Bogle must have liked those.
The concept, yes.
Yeah.
Excellent. Set and forget it, adjust automatically. But, and it's the crucial Bogle point, you have to look under the hood.
The costs again.
Always the costs. Actively managed TDFs, where there's still someone picking stocks within the fund, the average expense ratio is around 0.7%. That's way too high in Bogle's world.
So you want an index-based TDF.
Yep. Exactly. Low-cost, index-based TDFs average around 0.13%. That difference, 0.70% versus 0.13%, compounded over decades. It's absolutely massive. Huge impact on your final nest egg. So yeah, use a TDF for convenience, but make sure it holds cheap index funds inside.
Okay. Does Bogle see any role for human financial advisors then, or is it just buy an index fund and you're done?
No, not entirely dismissive. He saw value, but not where most people think. Not in picking winning stocks or timing the market. That's the loser's game.
So where do they add value?
Behavioral coaching is huge, helping you stick to the plan when you're scared or greedy. That's probably the biggest thing. Plus, practical planning. Figuring out the right asset allocation for you. Tax planning. Withdrawal strategies in retirement, how much you need to save. That kind of guidance is valuable, just not paying them to underperform the market.
Right. Be a guide, not a stock picker.
That's a good way to put it.
So wrapping this up, this whole deep dive, it really hammers home that simplicity and low costs aren't just nice ideas. They are like the fundamental keys.
Absolutely.
Yeah.
The lessons are simple but powerful. Embrace low costs above all else. Use passive indexing, just buy the haystack. And then, crucially, have the patience and discipline to just hold on. Forever, basically. Stay the course.
And the real value for you, the listener, isn't just knowing this stuff, it's actually doing it. Sticking to that good plan instead of chasing some complex, expensive, perfect plan that probably doesn't exist.
It links back to that other Bogle idea, right, about knowledge.
Yeah, an investment in knowledge always pays the best interest. And his follow-up. If a man empties his purse into his head, no man can take it away from him.
It's true. The money you save on fees is real money in your pocket. And the knowledge, the understanding of why you're doing this, stops you from making disastrous emotional mistakes later.
It really makes you think, doesn't it? Where else in your financial life might you be overcomplicating things? Overpaying for something just because it seems sophisticated, when a simpler, cheaper option, the haystack, is sitting right there.
Are you chasing needles? Or are you happy just owning the haystack and getting on with your life?
Something definitely worth pondering. Join us next time for another deep dive.